The final market model that we will consider is oligopoly. Oligopoly refers to an industry in which there are few sellers. How would we define few? Recall that when we defined many, as in, many sellers, it meant that there was a sufficient number of sellers that no one firm, by its own actions, was able to significantly affect the market. For our purposes here, we'll define few as a condition where there are one or more firms in the industry that are able to affect the market. Here are some industries that are oligopolies. The automobile manufacturing industry, national news services, telephone service providers, and producers of breakfast foods. A decision regarding pricing and output by any one firm in any of these industries will affect the profit-maximizing decisions of the other firms in the industry. The main factor that produces such a market model is significant barriers to entry. They are not insurmountable, such as those that made for pure monopoly. But they are significant enough to dissuade startups from attempting to enter the industry. This makes the firm in this industry difficult to model, because it adds a variable that is not present in the three other market models that we've already investigated. That variable is mutual interdependence. That term refers to the fact that there are now three things that affect the profit-maximizing decisions of the firm. The first two, as in the case of our previous three models, was price and output. In addition to those two, the third variable that the oligopolistic firm must consider is the profit-maximizing strategy of the other firms in the industry. It is this third variable, mutual interdependence, that makes the oligopolistic firm difficult to model. And that's why we saved it for last. So, for the oligopoly, we will have three models rather than just the one. The first of these will be the kink demand curve model. The next will be the game theory model. And the third is the price leadership model. Let's start with the kink demand curve model. What does the demand curve for an oligopolistic firm look like? We know that it's not perfectly elastic because there are only a few substitutes for a specific firm's product, so it must be downward sloping. We'll start with a straight line, 45-degree demand curve. And to further simplify things, let's assume that there is only one other firm in the industry. An industry with just two firms is called a duopoly. Consider the possible strategies of the other firm in the industry, the one whose demand curve is not showing. Let's narrow those strategies down to two possibilities. First, that firm can either follow this firm's price changes, or, second, it can ignore them. Suppose the other firm chose to follow all of this firm's price changes. That would make the demand curve for this firm's product less elastic. If this firm chose to raise the price of its product, it wouldn't lose any customers to the other firm in the industry because that firm would raise its price as well. Customers might leave the industry, but they wouldn't switch to the other firm's product in response. Or, if this firm lowered its price, it wouldn't gain any customers from the other firm because they'd be lowering their price too. They might gain customers that are new to the industry, but they wouldn't capture any of the other firm's customers. In other words, if the other firm chose to follow all of this firm's price changes, quantity demanded would be insensitive to price changes, making this firm's demand curve relatively inelastic. On the other hand, what if the other firm's strategy would be to ignore all of this firm's price changes? As you might have guessed, that strategy would cause the demand curve for this firm's product to become more elastic. A price increase would cause this firm to lose a lot of its customers to the other firm, who would be holding its price constant. Or, if this firm lowered its price, it would capture a lot of customers from the other firm. That firm would not be matching this firm's price cuts. So, many of its customers would make the switch to the now cheaper product. To sum up, if the other firm chose to ignore all of this firm's price changes, customers would switch back and forth between products. This strategy by the other firm would then make the quantity demanded more sensitive to price changes for this firm's product and would thus produce a relatively elastic demand curve. So, this firm faces two possible demand curves, dependent upon which strategy the other firm would follow. Let's just pick this price to start with. What strategy will the other firm employ? Follow or ignore this firm's price cuts? There's no rule that says that the other firm must pick a strategy and stick with it through thick and thin. It seems logical that the other firm would potentially deploy both, depending upon the direction of this firm's price change. If this firm raised its price, the other firm would benefit by gaining a lot of customers without having to do anything. Why would the other firm reject this gift, handed to it on a silver platter, by raising its own price as well? The other firm probably would not raise its price in response. Therefore, if this firm raised its price, the other firm would likely ignore the price increase. Recall that if the other firm ignored this firm's price changes, this demand curve would be made more elastic, because customers would be switching their purchases between firms. That means that above this starting price, this firm's demand curve will be the more elastic one, as shown here in red. However, if this firm lowered its price, it seems equally logical that the other firm would follow this firm's price cut to protect its customer base. Recall that if the other firm followed all of this firm's price changes, it would make the demand curve for this firm's product less elastic. Therefore, below the current market price, D1, shown in red, would be the relevant demand curve. Therefore, the demand curve facing the non-collusive oligopolist will have a kink. Above the current price, the demand curve will be more elastic. Below the current price, it will be less elastic. The term non-collusive means that these firms actually compete with one another. Collusion, a term you'll become familiar with in a few minutes, means to agree to cooperate. Collusive agreements sometimes occur in oligopolistic industries when firms want to avoid mutually destructive price warfare. Given this kink demand curve, will this firm be tempted to raise the price of its product? No. An increase in price would produce a dramatic reduction in quantity demanded, thus reducing total revenue and, ultimately, profits. Will it lower its price? If this firm lowers the price of its product, the other firm will follow its price decrease. Even a large price reduction would result in a disproportionately small increase in quantity demanded. So, it is very unlikely that this firm would lower its price. The conclusion of the kink demand curve model is, prices in a non-collusive oligopolistic industry are likely to be stable. Now, let's consider the game theory model of an oligopolistic firm. Here is our standard game theory payoff matrix, with which you are familiar. We will use it to determine if the firms in this non-collusive duopoly will charge a high price or a low price. Consider the following situation. The profits earned by each firm is $1,000 per period. However, if one firm lowers its price by, say, 20%, it could steal 50% of the other firm's customers. The other firm can prevent this from happening by matching that price cut. The possible strategies between which these two firms must choose is to charge a high price or a low price. If each firm charges a high price, each will earn a profit of $1,000. If company B cuts its price by 20%, it captures half of firm A's customers, leaving firm A with a profit of only $500. Although firm B gets half of firm A's customers, its profits are not $1,000 plus $500. Because it has lowered its price by 20%, it only gets 80% of that $1,500, or $1,200. The same thing would happen if firm A cut its price by 20%. If they both cut their price by 20%, there would be no redistribution of customers, but each would receive only 80% of their former revenues. That is, each would receive only $800 per period. You may recognize this as a classic prisoner's dilemma game. Indeed, market competition is a prisoner's dilemma. Each firm, as their dominant strategy, charges a lower price than the other firm, in order to steal its customers. But when they both try to undercut each other, both wind up charging a low price. The equilibrium outcome is the worst possible outcome for both parties. This outcome would be better for both. But, how would these two firms get from cell D, the equilibrium outcome, which is also the worst possible, to cell A, the best possible outcome for both? By colluding. Again, colluding means agreeing to cooperate rather than engaging in mutually destructive price warfare, which was the outcome of the prisoner's dilemma game. Such an agreement can only occur in an industry with few participants. That's because, when there are many market participants, it's hard to form an agreement with which everyone will agree. In addition, it's harder to identify and sanction cheaters to the agreement than it would be if there were only a handful of sellers. Antitrust legislation, which we will discuss in Module 10, makes this behavior illegal. The conclusion we can draw from the game theory model of a non-collusive oligopolistic firm is that it will charge a low price, but will be motivated to collude. The third model of oligopoly that we will consider is the price leadership model. In this model, the dominant firm, usually, but not necessarily the largest, can dictate prices that other firms will charge. What gives this firm the leverage to tell other firms what they must charge for their product? The power is derived from the threat of a strategy known as predatory pricing. The purpose of a predator is to kill, or otherwise harm somebody else. Predatory pricing is setting the price of your own company's product with the intent of driving other firms out of business. Hypothetically, the dominant firm in the industry could set the price of its product so low that it would suffer losses. Other firms in the industry would need to lower their own price to the same level, or lose most of their customers. They too, then, would suffer losses. The firm that could absorb the losses for the longest period would then emerge in a more powerful market position, possibly even a monopolist. So, in order to avoid being wiped out by the predatory pricing strategy of the dominant firm, the other firms in the industry dare not implement any strategy that might even hint at engaging the price leader in a price war. This would mean certain death for the firm. Therefore, every time the price leader raised the price of its product, all the other firms would fall in line and raise their prices as well. Again, we will cover this in Module 10. Predatory pricing is a violation of the federal government's antitrust legislation. In this video, we have covered three models of an oligopolistic firm. The first was the kink demand curve model. In this model we concluded that the product prices charged in an oligopolistic industry tend to be stable. In the game theory model we discovered that oligopolistic firms will charge a low price, but they are motivated to form collusive agreements with other firms in the industry so they can charge higher prices. And finally, with the price leadership model, firms in oligopolistic industries can be forced to avoid price competition with the price leader, under the threat of predatory pricing.